Hey everybody, if let me know you're here so I can put you down for the contest. We give out two $20 Amazon gift cards every Saturday. And if you want me to do a DCF for you, you can just donate on the live stream and I could run a DCF on any ticker. It takes about 5 minutes. So we ended the week strong. The market was up at the end of the week. Let's see if that continues. What do you guys think? Kevin, the first name. Yeah, everybody just comment so I know you're here so I can put you down on the raffle. How did everybody do this week? Sahil. Ashley. Joe S. Jake P. Yeah, a lot of people think it's going to be a short-lived rally and it'll start coming down. Who knows? Maybe it'll start. Now it'll be all upward from here. Oh, no, I don't think so. I think it's going to come down more, but who really knows? I mean, if you knew, you'd invest, right? If you were so confident it was going to go down, you would just short the market, right? It does make you feel good when it goes up, even after all this negative. It gives you hope. I don't know. I guess accounting maybe because it's so complex. So I have 8 names, 14 people here. Let's see what. So on Friday, AMC was up 18%. I'm going to do a video on AMC tomorrow. Upstart is up. Open Door. Charge Point, that's up. Yeah, Dell was up a lot. They had good earnings. Ulta Beauty. It seems like the high-end retail stores did well, and the low-end retail stores didn't do well. Oh yeah, the hedge fund. I got 2 offers. So I turned down the hedge fund, and I went with another company. It's less money, but it's more like this other company's more like a startup, and I'll be like the CFO running the finance part. So it'll be interesting Obviously, if they go public, then it would be great. But I don't really want to work 12, 14 hours a day. So that's another reason I really don't want to work at a hedge fund. But if it was my only offer, I would have taken it. I think Intel's a good. I don't think it will, but because I'm invested in it, I think they're a good company. But I don't see it really coming down much. If anything, it might continue trading sideways. But I don't see that much downside because it's so cheap relative to its revenue and earnings and cash flow. Nvidia is really down a lot, right? I mean, Nvidia used to be the largest semiconductor company, and now it's down to 468 billion. I think it was close to like 800 billion at one point. It peaked at about 330, so it was down 50% from its peak. It has come up since the bottom. Well, if you look at a company like Intel, come on, like that may have peaked at like a 58, down to like 42. So it's like down what, 25% maybe? Because it wasn't really overvalued to start. Like Nvidia was really overvalued and some other companies. But Intel, it was pretty much trading sideways since 2000. It really hasn't moved much. Okay, Ed. Blade. Joe. If anybody's here, you can just comment. Travel and Van. Yeah, semiconductors I think are a pretty good investment. There's some cheap ones out there, like Marvell is cheap. That's only 50 billion market cap. What's Intel? Like Intel's 180 billion, which I think is cheap for Intel. But there's a lot of but yeah, I think definitely Intel is a better value than. I want semiconductor. I don't think it's come down that much in the bear market. It's down 35% maybe. Not as much as Nvidia. Blade. So Blade 1, make sure you email me. Alternatively, if you win, I can just do a DCF for you on the live stream. Or I could do 2 DCFs on the live stream if you win. Either I could send you an Amazon gift card or you can do 2 DCFs. Intel is Walmart and Nvidia is Amazon. Well, I don't think Amazon is focused. I agree. Intel is doing everything. They're a foundry and they're fabless. They design the semiconductor chips and they manufacture them. Okay, well, let me know the tickers, and I could do it right now. And you could get 2 right now. Just throw out the names. Yeah, if anybody wants me to do DCF, you could donate any dollar amount. The more the better, but any dollar amount, and you can pick a ticker. Yeah, Dell had good earnings. Let's see there. Go Ed. Let's see. Go Ed. Go Ed. 731. 636. Any stock. Retail. Disney. What do you guys think of Disney or Foot Locker? Anybody have a preference? go ahead. 149. This might be hard with the penny stocks are a lot harder, but sometimes we get a what kind of company? It's internet retail. What do they sell? They sell washers and dryers. Yeah. Well, they have positive. I think in 2019 and 2020 it was positive. It's a bit hard, but okay. So I'm coming out with a stock price of 650. They don't really have positive free cash flow, so 2 years they did. So I grew their revenue. These are the revenue targets the next 4 years. And I used the industry average, what the average in the industry converts their revenue to free cash flow, which is maybe we'll do the lower number, 8%. So 578. Yeah, it's there's nothing wrong with it. Yeah, they're growing. It's hard to do a DCF unless the numbers are stable. But this is what you want to see: revenue from 56 million to 500 million. That's a good sign. I mean, if they did this organically, that's a really good sign. If they did it through acquisition, I guess that's okay. But yeah, but it seemed like a good value since it's so cheap. Brian D. I mean, they have a lot of competition. Anytime you sell online, you compete with Amazon. But they're specialized. It looks like they only sell specific products. So sometimes, like if a company focuses on one or two products, they sometimes can do well because they have more of a kind of a following, or especially if the products are more specialized, like unique and higher end. Well, let's look at their, see if we can look at their ratios. Yeah, it's hard to look at their ratios because really good price to sales, 0.3. So if a company has negative earnings and negative free cash flow, you could look at the price of sales because that can never be negative. It always has to be positive. So that's a good sign. And let's see. Isn't it's not a SPAC, right? It doesn't look like a SPAC. So they were almost $15. Hey Ben, what's up? Thanks for joining. I wonder why it dropped so much. In January, it was really high, and then it went to $1.82. So it's pretty close to the all-time low. Let me know if you want another one. A blade. What's payday? You mean pay safe? Is that what you mean? Payday. Payday's a candy bar, right? I mean, do you know why they? I think he means the day he gets. Oh, payday. Okay, I got it. I mean, the revenue looks great. Do you know why it went up so much? Especially from it went from 14 million to 64 million to 141 million. If that was organic growth, that's really impressive. But if that's just if that was just a couple acquisitions, it's because if you think about it, if you had a company, right, and you went from 64 million of revenue one quarter to 141 million of revenue. But if I said the reason we grew 80 million was we just bought another company, I mean, that doesn't really, there's nothing wrong with acquiring another company. I'm just saying it doesn't really prove that you're growing sales. But if you did this organically, like you're you're able to convert more clients, then it's very impressive. But I mean, it looks good. look, they went from well, so you see, in January they had 14 million of revenue. The first quarter of 2021, and in the first quarter, their stock was almost $3. Then their revenue went up 5x in the second quarter. So by the end of the first quarter, it was down to like $1.30. Then they 5x their revenue. Wait, this is 2022. Oh, we don't. Oh, they just started trading, and okay, so we can't get the data. They just started trading in July, which would have been right here, which is after all this growth. So, okay, forget about it. We can't really look at it, what I was talking about. If you track a company's revenue and track their stock price, and it's funny, a lot of times you see it go in the opposite direction. As their revenue goes up, their stock price goes down. You'd think it would be the opposite. You'd think it would move together. But okay, yeah, Blade, did you pick a second stock? ASO. If anybody's curious, this company that hired me, the guy who started the company, he created this he makes medical devices, but the problem with most medical devices is they're plastic, which is bad for the environment. So he makes an all-natural, plant-based medical device. All different medical devices, like one-time use medical devices. You use them once and you throw them away. But it just adds so much, so much plastic and so much waste. Because in order to make a plastic product, there's a lot of waste occurs, right? So and they've been growing quickly the past few years. So they want to hire someone to run the finance part, because they don't even have somebody in finance. It's more of a bookkeeper. So he sold 1.4 million units, which saves 115,000 pounds of plastic, reducing 111,000, I guess, kilograms of CO2 emissions. So that's the idea, making an all natural surgical product. But maybe they'll go public one day. Maybe I'll be rich. Let's see. Yeah, and somebody, one of the subs here might work there with me. One of my subscribers. Okay. 13. Why does Dell have negative free cash flow? Yeah, let's look at that in a little bit. $14. Eight people have gotten picked. This might be a record, 9. So far, half the people have gotten picked once. Okay, Agav. So, yeah, Agav, you can email me, or if you want to no, I don't think they use Salesforce. It's a really small company. They don't have many things. They don't have much in terms of systems. ASO. I think I did a video on ASO once. See, ASO. Specialty retail. Come on. What do you guys think? Over or undervalued? Yeah, pre-revenue. Yeah, I've looked at. Yeah, all different types of companies. It's harder because you have to kind of, predict the future unless the company gives us their, their revenue targets. Yeah, so undervalued. We'll see. It's so simple, the model, right? It's just a few inputs. It seems awfully high. Oh. Let's go with the higher whack. Um, let's just lower this to 6%. How do you choose growth rates? What do you mean? What do you mean growth rates? You mean the revenue growth rate or the terminal value? Seems pretty undervalued. I'm coming up at 65. I'm trying to make it conservative. It hasn't come down much in the bear market. It peaked at 50. Well, maybe it's the whack. I just pull it from Finbox. I just go to the company on Finbox and they give a range. I usually do 2.5% for terminal value. But I could always adjust it. Even in a it seems pretty undervalued. Let's see the I mean, look at that price to free cash flow. It's under 5. Hey Jim, what's up? They have really good ratios. The negative earnings, so we can't look at their earnings. If anybody wants a DCF, you can just donate. I usually take the middle whack. Sometimes I'll take the lower or higher whack. There should be a donate button, like a $sign, on the chat somewhere. Sometimes I go below the low or above the high. I used to calculate the whack myself, but I don't know. I may start calculating it again. I'm starting to get more comfortable with. It's hard to calculate the cost of equity because the whack, you have to figure out how much money it costs a company to borrow money using debt and equity. So debt is easy, but the equity is kind of hard. Yeah, revenue looks really good. I wonder why there's no PE on this. TWLO. Look at that PE. It's a 5 PE. It seems, I wonder why it's so undervalued. Let's see, Twilio, 10.3. It seems like most stocks are undervalued. Wall Street, Gates, Sporting Goods. Big Five, Dick's. Yes, some stocks or certain industries always seem undervalued or overvalued. It's just how it is. Yes, sometimes you invest in a stock because it seems really undervalued, and then you sit on it for years. Then you just realize that it never goes up. That's just how it is. Thank you for the donation. Yeah, Doge is going to be, it's going to be under a penny by the year end. It's so stupid. I think Bitcoin will go up over time, and some others, but there's too many. Okay, so negative free cash flow every year. Okay, so it is a little harder because I have negative free cash flow. I'm at 61. Let's go with the higher range. Let's go to 16%. 61 to 82. Let's just see where it's been trading. Well, that was, yeah, it's 400. Wow. It's really come down. Sheesh. It's come down 75%. But so it's, when a stock comes down like so much, like 50% or more, so it's either it's going to go back up once the bear market goes away, or it's going to stay at this level because it should never have been that high to begin with. So which one do you think it is? Let's look at their ratios. It's hard to look at they're growing at a 59% rate. Their revenue growth is amazing. It's better than their revenue is still low relative to their market cap. Their price of sales is 6, the average is under 3. So they're not bringing as much revenue as most companies. But that's what happens when you're growing at a 59% rate. Your stock price balloons up way past where it should be. And then once growth subsides, like what's happening with Amazon and Facebook, then you see the stock price starting to come down. Let's do Clover. Yeah, but the DCF is just one tool, you know. There's you know, nothing can predict the stock price. It's all mystery. Clover. I did a video on Clover. It can't even be valued. $4.9. You know, there's a lot of assumptions. Like I'm using the revenue forecasts because each company usually provides revenue forecasts. But just because they provided the company doesn't mean they'll hit these forecasts. They may actually go higher or lower. There's no but a lot of companies usually come close to their forecasts, or they usually actually beat it by a little bit. That's the goal, because the stock price will go down if they don't beat it. Would you take a look at Liberty? Can a stock be undervalued and decent, but still be overvalued? Yeah, I mean, I'm really tall and I'm really short. You know, relative to someone who's 5 foot, I'm really tall. Relative to someone who's 7 foot, I'm really short. So of course, yeah, it could definitely be overvalued, undervalued, depending on how you look at things. Okay. Yeah, I'm kind of excited about this company. It'll give me a new. I told the company. I called them on Wednesday, and I talked to the boss, and I said, I got another offer, so I kind of need to know this week whether it's a yes or no. And maybe that kind of motivated him, or maybe the fact that I got another offer. And I told him it was a hedge fund, so maybe he Maybe that added to my credibility. But he saw my YouTube channel, so maybe that helped. But I've purchased stocks that were like, I bought Costco when it was overvalued in my model, and now it's up 70%, 80%. Now I'm like up 10%, but and I've and I wouldn't buy certain stocks that are undervalued. So it's just okay. So this is another hard one because there's no. Let's do a more conservative model. Okay, so this is weird. I wonder if this is right. They had 460 million of revenue in 2019, no revenue in 2020, and then 1.5 billion in 2021. You mean the 4%? This is like, I'll put the equation back. This takes the sum of the free cash flow numbers and it divides by the sum of the revenue numbers. So if they had positive free cash flow, I would be able to identify like what percent of their revenue they convert to free cash flow. It's easy to explain with a company with positive free cash flow, but that's pretty much what it is. The percent of revenue they convert to free cash flow. And say it was 6%, then I would multiply their future revenue estimates by 6%. But since they have negative free cash flow every year, I can't use the number because it gives me a negative stock price, which is impossible. So I just use the industry median. The median for the industry is 4%. The average is 7%. So then I use kind of the industry median or average to figure it out. But it's a pretty, I think it's a pretty simple, and it comes close a lot. It seems to work. Of course, there's a lot of stocks it doesn't, but so I try to do a conservative model, and let's just assume they have negative free cash flow the next couple of years also. Oh, that's interesting. So I'm at intrinsic value, assuming they have negative the next 3 years. And I'm assuming their revenue, they hit these targets. These are the revenue targets for the next 4 years. But this is a conservative model. I try to make the numbers as conservative as possible. But if they grow at 2.5%, they convert 5% of their revenue to free cash flow. So you can see it's really, a lot of it is just kind of guesswork, especially with a company like this. You do a big company that has positive numbers every year and consistent, then DCF should make more sense. Wait, did we look at the? Oh yeah, we did. If the earnings go down, Well, earnings are not part of the DCF. It's revenue and free cash flow. Until, yeah, if anybody wants me to do another, so yeah, these live streams help because my earnings, my revenue from YouTube is down a lot. I think my views and everything's down about 50%. So at least my revenue is not down as much because of these types of live streams. But you have to look at the company. A lot of it is looking at the company, which I do more of. The DCF is probably maybe like 10% of my decision. Like I would look at the company. Clover Health. Well, first I want to. The first thing I do is just make sure the product is something that's even makes sense. It's investable. Like for instance, BarkBox. They sell subscriptions, so you can sign up with the company, and every month you get a box with dog toys and dog treats. And I get it. I don't think it's investable. I think it's a good business for like. I think I could pay. It could employ a lot of people. It could maybe make the owner $1 million, $500,000 a year. But I don't think it's an investable business where it can grow and scale to $100 billion company. So that's probably a company I wouldn't invest in. So first you want to make sure the product is the demand's there to like grow to a certain level. Healthcare demand is definitely there. And then you want to try to is it scalable? Is it because certain, like Uber, for instance, I just don't see the scalability and the margins. Because every time you generate revenue, you need a human to bring another human to some place in their car. So you need a lot of people, a lot of like manpower. So it is scalable, but this, like a business like this or a business like Facebook, is really scalable. It's very easy to like grow as much as you want. You could pretty much grow to infinity. Where a company like Uber, you can't grow to you can only grow by as many people willing to drive. But I don't know. I'm just trying to like. I should make a video because it's hard to come up with it, but like the things I think about, the high level things I think about. But that's not to say you could make a ton of money in like these crappy stocks that don't go anywhere because you got in when they were really low. You can make a lot of money with anything or lose a lot of money with anything. It's pre-revenue. I mean, yeah, utilities are scalable. Not as scalable as a tech company like Instagram or WhatsApp. It's so easy to scale those kinds of businesses. You do need to build out infrastructure, depending on obviously what utility company you are. But you need to build out a lot of infrastructure. But if you build the infrastructure, you can sell your product to an entire community pretty easily. A company like BarkBox, you have to find people with dogs. That's your first step. Then you have to find people who are willing to spend money to get a package in the mail. So it's a little limiting. But yeah, but if you're like Netflix, like I'm just gonna always have Netflix, for instance. Like, I mean, I know some people don't like it, but it's pretty cheap, and I get a lot of usage out of it. And so there's probably never gonna be even if I don't watch it 1 month, I'm still gonna keep my Netflix account going. Where if you're receiving like a product in the mail, it's easy kind of to turn that off. I don't know. It's hard to focus. I don't know if I'm explaining that right, but what ORGN? Yeah, thanks, Jeff, for the donation. West Sacramento. So it's pre-revenue. So this just makes it a little more difficult. We have to kind of trigger, use inputs that are not part of the company. The ideal model is you would use all the values connected to the company. I'll show you when we do a positive free cash flow company. Okay. Yeah, it's kind of hard to. Like Jeff said, this company has 7 billion pre-orders. So if you have more information like that, it can help you. Right now, it's pretty limited, our information. But if they have 7 billion pre-orders, I wonder why their revenue projection is only 114 million for 2024 and 59 million for 2023. 7 billion, that's a pretty big number. I mean, what is it going to go out for 30 years? Because 100 million by 20. But this is, yeah, DCF doesn't really work. You want to dig into their, yeah, that's a good point, Jeff. They're building out their factories. So yeah, if you see, we could push the model out another 2, 3, 4 years, and then if we have an idea of what their revenue will be. Yeah, never heard. A lot of these companies I've never heard of. Origin Materials. Even if you find a winner, like if this company becomes huge one day, even if you identify it now, you might have to wait like 5 years before seeing anything, which a lot of people, I'd say like 99% of investors can't do. They can't wait. They can't even wait a year or even 6 months. It's about carbon negative materials company. The origin platform terms of carbon found. See, it sounds good. I'd be a little. I don't really understand it that well, but like I understand a lot of I understand what Tesla does. I understand what Amazon does. Like I kind of, it's a little confusing, but that doesn't mean they make plastic out of wood waste. But isn't plastic bad for the environment? Okay, plant-based plastic. Okay, that makes sense. They make, yeah, those are big partners. Pepsi, Nestle. The thing is, with like if you ever go to like a really high-end resort, like a really nice hotel, they don't use plastic straws. They'll use paper straws. But paper straws cost like 10 times as much money. Like a plastic straw is probably like 0.001 cent, and these paper straws, I remember buying them for my business. They're like 25 cents each or something like that. So if you go to a really high-end resort, they can afford, because they have a lot thicker margins, but if you go to most places, they can't afford. Like if you go to McDonald's, they can't afford to buy paper straws instead of plastic. But unless the company can find a way to make it at a pretty, maybe not as low as plastic, but a lot closer in price. Yeah, it looks interesting. Paper straws cost 5 to 12 cents per unit, while plastic costs under 2 cents. Okay. Any other ideas? Oh, we didn't look at you can't look at their ratios. Their price to book is okay. What else? Foot Locker. Oh, so this is a SPAC. Origin Materials is a SPAC. It's actually holding up pretty well for a SPAC, because a lot of SPACs go below $2 after like 6 to 12 months. This didn't really go up much. It went up to 13 from 10. And that was in February of 2021. It bottomed out at under $5. West Sacramento. They're a pretty popular company. I usually get a lot of views for Algonquin videos. Yeah, the revenue is up a lot. All these commodity stocks are doing pretty well. They're investing a lot in CapEx. 1.3 billion. Okay, I guess I'll if nobody else wants a DCF, I think I'm going to close out now. I have tomorrow is Flutter Entertainment. Somebody paid for that one on my Patreon channel. I did AMC today. Amazon, that got a good amount of views. I mean, views are down a lot, but I used to easily break 1,000 views per video, and now it's like a lot of my videos are getting some not even 500. I mean, look at these 389, 342. Like it. Yeah, if you see, this is back in April. Look at 1,800, 3,500, 1,200, 2,000, 2,900, 1,700, 2,000. This was under 1,000, but 12,000, 6,000. I mean, so many more views, right? Every video is like 1, 2, 3,000. Now it sucks. Okay, I'll see you guys next Saturday. Thanks for joining.